I'd like to ask you first of all for perhaps a brief description of multi-asset investing and maybe a little bit about your team.
Our team has been around since the late 1990s. We have been running multi-asset portfolios for that entire period, applying a very distinct philosophy and process to generating returns.
For institutional investors, such as local authority pension funds, finding suitable returns at lower volatility is something of a holy grail. Can you tell us a little about how your fund aims to address this?
I think it is a holy grail. I believe you do need to take some volatility to get the returns. I don't think markets are as generous as to provide that level of return without an element of volatility. But we believe that if you use multi-asset investing and you access areas like fixed income, property, be more dynamic within the equity asset class, then you have a very good chance of being in the equity at the right time, reducing exposures when it's potentially extended, and having exposure to more attractive asset classes such that over time you get pretty close to that equity return with a much lower volatility.
Do you feel that this can't be done consistently with a static multi-asset fund?
Very much so. If you look back historically, the static allocations with the more traditional multi-asset funds, where you had simply a basket of equities, a basket of government bonds and some property assets, they have served investors incredibly well. So you've had very strong returns and good diversification from your bonds for your equity assets. The challenge today is with bond yields very, very low, one of the major asset classes is priced for very, very low returns. So if you're relying on a big strategic allocation to bonds to provide diversification, we would believe that going forward the returns are going to be much, much lower than they would have been historically, certainly over the last 30, 35 years. So I think going forward you're going to need to be dynamic, you're going to need to be a lot more selective within equities, a lot more tactical with your fixed income exposures, make use of the currency complex as well to help manage volatility.
Different people, firms, have different approaches to capturing investment returns. Can you tell me something about the philosophy behind your approach?
So what we really observe is much more fruitful for a multi-asset strategy is an observation really on asset markets. And that is that periodically, not all of the time, but periodically, volatility in markets may have more to do with the emotional aspects of investing rather than about the fundamentals. And if during these phases valuations are becoming quite dislocated, we would view that as potentially a very, very good opportunity to be making an investment in a market if it's looking very cheap, and emotion seems to be the dominant driver of price at that point in time rather than fundamentals.
Do you think value works from an asset allocation perspective?
Absolutely. I would still say today that the best guide that anybody has to the likely long-run sustainable returns from the asset classes is valuation. And this is much more the case at the asset class level than it is at the individual security level, because you get much more diversification in the fundamentals at the asset class level, so valuation's much more powerful. And I think the long-run data set would back that up as well when you look at the long-run studies that have been done.
The elevated volatility in financial markets and very low bond yields are a real challenge for pension funds. How can an investment in a multi-asset fund help to manage those challenges?
So unless government bond yields go further into negative territory, it's pretty hard for bonds to give you anything like the returns they've given you historically. But more importantly, from a portfolio construction point of view, their diversification properties today are also questionable relative to the last 10, 20 years. So I think in order to manage volatility, you are going to have to be much more dynamic. You can't simply set and forget a strategic asset allocation. You need to be moving that around much more in response to the volatility that you see, and be much more targeted when you get your individual exposures.
Many people feel that we are entering a low return environment. Does this make it harder to achieve the types of return that you have had in the past?
Many of the bond markets globally now have yields in negative terms in nominal space. So that looks like a pretty low return world if you're investing in cash and bonds and you're simply buying and holding. That wasn't the case over the last 20, 30 years. You had equity-like returns from bonds. I think the good news today is if you look globally and you cast the net widely, equity assets look fair to slightly cheap. So they're still priced to give you returns that you ought to receive for equity investment, perhaps a bit lower than we got used to in the 90s and the last decade. But simply buying a bit of each asset class, you are going to get lower returns, I would say. So you do need a multi-asset fund to be dynamic and access a little bit more specifically the areas of those asset classes that are interesting.
Thank you very much, Tony.
Thank you.